The next question I have is specifically for new homeowners. What is the typical write-off or deduction for your purchase of a first home? Or what can you expect for your first filing as a homeowner the very, very, very first time?
Okay, so of course, in the year that you're purchasing your first home, right, you're gonna keep your closing documents because we have all of those expenses that go with it that are gonna be added to basis because now we're tracking basis.
Okay.
Now, again, we have the property tax deduction and we have the mortgage interest deduction. They need to be looking for, you know, their 1098 to be coming in the mail from the bank in January. Plus, they need to know enough to bring in their property tax bill, you know, in the payment
Perfect.
to their tax preparer. But again, we're getting into the, you know, are we going to be itemizing or are we going to be taking the standard deduction?
Okay.
You know, it all comes down to that since 2018 when the Trump laws changed.
So, which leads me to a next question, which isn't technically on here, but I'm gonna ask anyway. So, good practice. You buy a home, you get your closing packet, which is usually a packet of papers.
Yes.
You put your stuff in there. Wise to start to write down every time you change a toilet, you do a roof, you change your flooring, you buy a new washer and dryer. Every receipt for every improvement going in there so that you have something if you choose to sell it in 5 years?
Yes, that would be good practice. Now, there are going to be some things, the flooring can be added to basis, but the washer and dryer can't. But as a general rule, just throw everything in there so when you get down the road and you need it, then I can say, no, yes,
No, yes.
yes.
Perfect. So excellent idea for closing gifts to the team, to give them a book or portfolio of something
Right,
that would be
right.
like a record management thing for
Right.
when they buy their home.
Right.
Okay. I believe at this point Becky had a quick question for you.
Oh,
How
yes,
about
I do.
I wrote it down so I wouldn't forget.
What do you think is the biggest or most common deduction or mistake that people that do their own taxes make?
Oh.
Asking for a friend, of course.
Let's see who does their own taxes.
Well, many times people are trying to do things like, you know, figure out gains and losses. They don't know what basis is. They just don't know what it is. Particularly when you're doing a like-kind exchange that we're going to talk about next. They don't know how to calculate it. Another very common mistake that I see is not taking that property tax or rent credit on Wisconsin. I see it all the time, particularly from people that do their own taxes. They bring it in, and the first thing I do is look at page 2 and say, where's your credit?
We like credits. We definitely
Yes.
like credits. Credits are good.
Okay.
Great question, Becky.
Thanks, Julie.
You're welcome. The next question we had is just some other things. When buying and quickly selling a home, which actually the last couple of years we've seen, be it a primary or second home, is there a rule of thumb for how long you should wait to sell, even if it's for capital gains?
So, if you are not going to be entitled to the exemption, the principal
Which is
residence exemption, which is 2 out of 5 years, ownership and residence, then you probably want to at least hold on to it for a year because it is the difference between a short-term capital gain, which is taxed at the ordinary income tax rate, and a long-term capital gain, which is limited to the 20%.
Okay.
And most likely the 15%.
So, okay, so if you sell it prior to that 1 year, you could be looking at paying a much higher income gain tax than if you wait for that 12 months.
Yes, your rate is going to be
Perfect.
higher. Yes.
That's good to know. So somebody who buys a house, they remodel it, they fix it up, even if they have it ready on the 9th month, they should
Yep.
wait until the 13th
At
month
least
to
don't
sell
close.
it. Yeah,
Yep.
just to close. Perfect. Good question. When purchasing a second home for income, what is the tax perspective in purchasing as a second home or a commercial investment?
So, you're talking about whether you're going to use it personally as a second home or have it rented, for example, a weekly rental.
Yep.
So yes, you can do that. You can use it in both ways. If it is a 100% rental, then you can use it personally for 14 days or less. That's what the IRS allows. It's the greater of 14 days or 10% of the rented days. If you are going to use it for more than 14 days or 10% of the rental days, then you're talking about having to prorate all of the expenses, including utilities, mortgage interest, property taxes, everything. However, if you use it for 14 days or less, or the 10% of the rental days, you can allocate 100% of those expenses against the rental income. Now, there is another little exclusion.
That's a good thing to
that
know.
you can rent your property for 2 weeks, for 14 days.
Is that the Augusta rule?
Yeah, and you don't have to claim it at all.
I love that. So let's go over that one more time. So if you are buying a home in northern Wisconsin and you plan to use it as a rental property primarily, but want to have maybe your family vacation up here, or come up here over Christmas or the holiday,
Right?
that's 10% of the total rental days, or no greater than 14 days.
The greater of 14 days or 10% of the rental days.
Okay.
So now keep in mind, if you're up here doing maintenance, I have a rental property. I just got back from Cape Coral, but we were doing maintenance the entire time we were there. Those are not considered personal days.
Oh.
They are considered, you can take maintenance blocks, stuff like that. You can do maintenance. You got to come up here. You have to, paint the siding or whatever needs to be done. Those are not counted against your personal days.
So then in that scenario, which is what I talked to some of our buyers about up here, is in that scenario though, their trip up here is a tax write-off.
Yes.
When they take their meal up here, that's a tax write-off.
Yes.
Those are all tax write-offs because it's part of that maintenance trip.
Yes.
Okay?
So
Which I
now,
think is huge.
also understand there's a big difference whether your rental property lands on Schedule E or Schedule C. Now, Schedule E would be for a rental, long-term, year-round, month-to-month rental. These short-term rentals, if you are cleaning and giving them supplies and providing everything, giving them substantial service, that is not a Schedule E passive activity rental. That is a Schedule C business. So if you have income, of course, you're going to pay self-employment tax on it. But if you have losses, you can take those losses.
So if somebody has 5 or 10 long-term rentals, but they don't have any short-term rentals, I would assume, depending on where their income level is, having a short-term rental for some of those reasons is probably in their best interest versus another long-term rental, because there's going to be tax advantages there, like the losses.
Well, long-term rentals, if the residence is, they're depreciated over 27 and a half years, and the IRS does allow up to $25,000 in losses, depending on where your income
Sure.
is. There are always phase-outs. But generally, they allow $25,000 because it's a residential rental, and basically the idea is, you're providing housing.
Right.
Housing. So, yeah, you should talk to your tax practitioner, because it does make a difference. Everybody is different.
Yeah.
Everyone thinks everybody's in this box, but that's not true. I mean, everybody is different.
Interesting. The next question we have, is it true that when buying and flipping a home used as a primary residence, you do not have to pay capital gains as long as the next house you buy is more expensive than the previous one?
No,
I didn't think so. Okay. Yep.
it's not true at all.
Awesome. Okay. If Mr. and Mrs. Smith buy a home to use for both investment and personal use, how much of their time is limited to personal use? I think we already covered that one.
Yes.
And can they rent it most of the time but still use it for fun weekend getaways at zero limit?
We're
So we
going
already
back to the
covered that.
14-day
Yep,
rule.
or 10%.
Right.
And then are there better tax advantages to owning property as entities such as a person versus an estate or versus a trust? That's a great question.
It's tax-wise, not really.
Doesn't
They're
matter.
all going to be taxed. Typically, when you set up a trust, it's set up in your Social Security number, right?
Okay.
And it just goes on your personal tax return. And in estate, I mean, I don't do a lot of estate work, but I mean, all of that stuff flows down anyway.
Okay.
So, yeah. And the thing with the rental property is it's not subject to self-employment tax unless it's a short-term rental on Schedule C. So you don't have any of those issues
Okay.
with passive income.
Perfect. Now, one thing we didn't talk a lot about is the 1031 exchange, like-kind property exchange, and I've seen more of those since COVID than I've ever seen in my 20-year career.
Right.
Why don't you tell us a little bit what that means, what it is, how it works, how it functions?
So if you are sitting on a business or investment property, cannot be personal property, you can exchange it. Typically the exchange is done for a higher valued property, but it doesn't have to be. You can pay tax on some of it. Then you're looking at taking the basis over here. Say you paid $100,000 for something. You probably depreciated it unless it's investment. You know, it
Yep.
could have been a rental. It's depreciated down to $80,000. You buy a $200,000 house. Well, say you sold it for $200,000, you got a $120,000 gain, right? You buy a $200,000 house. Well, your basis becomes $80,000 again, because you haven't avoided the tax. You've just you bought like property and you've deferred it until the eventual sale of the final property, and that's when all the tax kicks in.
So, example, what we've seen a lot of up here, they either own a property someplace else that's an investment property or rental property, and they want to buy one here, so they've sold that one and purchased here, or they had one here and they want to go to Florida or Arizona, so they're selling here to make the move down there. Now, I think the one question that I get all the time is, well, we're going to live in it. I know we're selling our rental, but we're gonna live in it. That's okay, isn't it? And of course, I always tell them you need to talk to your accountant, but
No, it has to be business or investment for business or investment. And I know I've had people come to me, you know, who catches you is the state of Wisconsin, is who catches you. And if you're gonna sell in Wisconsin and buy in Florida, you have to pay the Wisconsin tax. The like-kind exchange only works in Wisconsin for a Wisconsin to Wisconsin property. It works on the federal level, but it does not work on the state level.
okay, so explain that to me.
You have
Because I guess if you have a property in Wisconsin, you're exchanging it for something in Florida, you have to pay your Wisconsin tax, but not your federal tax.
right.
Okay, perfect.
The
You're
the
getting,
federal gain gets kicked down the road,
but not the
but the
Wisconsin.
state does not.
Okay, that makes perfect sense, and actually that answers some of my other questions. So when you say business or rental, can it be business to rental?
Yes.
As long as they're
Yes,
both investment
yes,
or,
yes.
okay,
As long
okay.
as they both qualify in either side.
And then just out of curiosity, so you kick that ball down the street until you're in your 80s. When you get to the end and you have that final property, when that property sells or the eventual death of the owner of the property,
See-
then what happens?
Well, that's why you hang on to that last property until you die,
Okay.
and then you get step up, right?
Oh, makes sense. So that's
Right.
how the accountant looks at it instead of the
Yes.
gifting. Okay,
See, if you gifted, you would be paying Uncle Sam tons of tax.
interesting.
That's how that works.
So if you do a property from a like-kind exchange to another like-kind of exchange and you've got that property here, can you then turn that into a primary residence after you've rented it for a year or 2 years? Can it become your eventual
Yes.
primary residence?
So what the IRS will look at is your intention. So
Okay.
they're gonna look at this side of the transaction, they're gonna look at this side of the transaction. They're gonna say, what was your intention? If your intention was to rent it for a year and then make it your principal residence, it's probably not gonna qualify. However, you can rent it on the other side for a couple of years and then realistically make the
Turn it
decision.
into,
Right, they're gonna look at your intent at the time you did that like-kind exchange.
perfect. Because that's also a beautiful thing, because we have so many people that are 5 or 10 years out from turning it into occupancy here, so that could
Right, then you're
easily
fine.
be
You're
an
fine.
option for some
You're
of them.
It's the intent of the exchange, you know, of the buyer and the seller at the time you made the exchange, not
Awesome.
5 years down the road.
Awesome. I think that's all the questions that I have. Did I miss anything, guys? Anything we didn't
No,
get?
that's a lot of good stuff.
Yeah.
Yeah.
Did I miss anything, Linda?
I don't think so.
I think she did awesome. So if you need information, you're looking for accountant, you're looking for advice and services, all of Linda's information is here. Feel free to give her a call. And again, share this with somebody you know. If you have questions, give us a call. Give Linda a call. We're happy to help. Have a great day.